Well, Anthony, I have something to tell you, and that is the aspect that one of my friends just texted me and said that even though we just did that epic intro, apparently it wasn't fully live, and that we're going to have to start from the top there, despite that awesome intro from you, because now we are live. And ladies and gentlemen, you may have just missed it, but Anthony and I just had about a 3-minute fantastic chat about how he got started at 20 years old and was a CME member. I don't know anyone in my personal network who is a CME member that or got that young or got involved in futures that young. And I think that's actually a great starting point. And before I get to that intro again, let me just remind everyone about this special show because this is the final live show before our epic leap competition comes to an end, which is sponsored by the Chicago Mercantile Exchange or CME Group. And with us today is Anthony Crudelle, who is a 25-year experienced trader and now senior vice president of NinjaTrader Live. He spent his career refining his approach to discipline and risk management, precise entry and exit strategies, and now plays a key role in enhancing the NinjaTrader platform. And what's really important about this as well is NinjaTrader currently is in beta as an integrated broker on TradingView. So we've got a lot to discuss here, from futures trading to NinjaTrader to the Leap and CME Group. But before we get into it all, I'm going to pass the mic back to Anthony because I want him to reintroduce himself and how he got started in futures trading at the age of 20.
Steph, thank you so much for having me. A lot going on right now in the futures world. It's really a great time to be in this business. And thank you so much again for having me here. I'm excited for everybody in the Leap Challenge. It's coming to a close. I saw some of the numbers that people are putting up. I think it's pretty cool, and it's great to showcase futures as the products just continue to grow at just a massive level. It's growing like nothing I've seen before in my career. So just the quick story of my background. I started on the floor right out of high school. I started on the floor by accident. When I say accident, it was a literal accident. I got in a car accident. I took a job as a runner. I looked in the newspaper as I needed to rehab my leg, and that's the reason why I took the job as a runner. So there's kind of interesting how the whole thing got started. But once I got on the trading floor, I never wanted to leave. I started in the meats, worked in cattle, lumber, and that's where pretty much most people start. Then I went and worked in the Eurodollar options. I spent some time up there, and I realized that those guys were just way too smart for me, Steph. There was no way I was staying there. A friend of mine who I had met through another funny story comes up there one day and says, "Hey, Anthony, you want to come and work in the S&P 500 and work for some locals? Locals are independent traders." I'm like, sure. I went down there. I interviewed with the guys. They're like, listen, if you could work in the Eurodollar options, you could work down here with us. There's a bunch of knuckleheads in the S&P. So it was kind of fun. And that's where I began. And, during that time was 95, 96. Even the S&P was all the whispers of futures going electronically at that time. And anybody who was around back then knows everything was really gone through the pit, and electronic trading was rattling the cages of the futures industry, because it was going to be a change. And I was actually at the forefront of that. I was there right when they started the electronic trading. I didn't start to trade it right away, but after a short stint in the pit, when I became a member, I went through membership at 20, became a member at 21. I went right to the screen just because I was not a great pit trader. They weren't trading with me. I was a young punk. And so although all my friends were making money in there, I was the dark horse. I've been on the mini S&P since pretty much its inception. So, fast forward to here we are today. I still trade it, and I love it. I love this business.
So there's so much to unpack there. And hello to all of our live viewers. I love seeing a few people just popping in to say hi right off the bat. And what I would first ask you about that is, you mentioned that you were a runner. And I have to ask, so if I'm 20, does that walk us through what that means? And if that job even still exists since all that digital trading has taken off?
It doesn't exist the way that I did it, right? I mean, I'm sure that there's probably some trading firms out there that have people that are, maybe they call them runners. I wouldn't know of any really offhand, but as far as a runner goes, it's the very entry level when you are working on a trading floor. And basically what you're doing is you're running orders from a broker desk to a
And,
broker in the pit,
and you mean
and you're
literally
running what's
running?
called paper. Yeah, well,
Like
you
you're
kind of,
actually
what's
running
funny about
on the
this,
floor, or?
you can't run on the floor. That's the one thing is like you can't run, you can walk fast. And you see the way some people walk fast, it was always pretty funny to me. But you could walk fast and you would take an order. So an order would get printed out on the desk. And then that broker, the desk broker, would then rip it off and say, bring it to, live cattle. And I'd bring it to live cattle. And then I'd go and I'd hand it to that clerk who then would turn around and put it in their deck. That's why we called it paper. And then they put it in their deck. And then they would, as that order got near the price, he would turn around and say to the broker, he'd be like, work 3/2 on 50. And he'd be like, okay, who's this for? Right. And he'd be like, then he bid 3/2 on 50. Right. And, I got 50 filled. He'd fill it, take it. Then from there, the runner would then take the order that was filled, the dupe, and then it would take it back to the desk, timestamp it. You had to timestamp it. It was important. And then we put it into a bin. And then as time went by, I'd go around, I'd collect all the cards from our traders, from our brokers, and we timestamp them all, put them in a bin. Then we'd run them upstairs. And then we go up there and then you'd have key punchers. They would punch in each order and there'd be rows of people sitting there putting in trades in, and then they would match them in the system. And that's how business was done.
Wow. I know. So I can, if I was, when I look back at my career, if I could be, as an intern doing something like that, I would take that in a second. I don't even think I knew it existed at the time, but you experience.
Yeah, because you understand that, well, number one, you understand the client, right? And when you start in the meats, the clients a lot of times are farmers, right? I mean, this business is built on hedging, right? And so when you're in the meats, you have cattle farmers, cattle ranchers that are putting orders in to hedge their cattle. Same thing for the crops. I was at the Merc, so we didn't have, the commodities like wheat and beans. That was at the Board of Trade, but we had cattle, feeder cattle. It was live cattle. We had lumber. We had pork bellies, no longer a contract. Everybody knows pork bellies from Trading Places. I think that was mentioned in there, but nonetheless, that's you learn where the business really started. And I think fundamentally that's so important because there's actually physical delivery taking place. And if you never work in the commodities side of the business, you may not understand it, but that price up there for the cattle was where all the cattle was priced, right? That all of those different things that happened with price action in intraday and where that price settled impacted not only those ranchers, but everybody who bought meat. And so I found that to be very interesting and fascinating, and it helped me understand really the roots of this business.
So I love that aspect about futures trading because we have this contest going on at the moment. Many of you are probably familiar with the Leap, this time sponsored by CME. Specific futures contracts were traded. Almost 60,000 traders are signed up and trading in it right now. First place is going to take home some cash prize. I should be able to see the cash prize. Here we go. So first place is going to win $3,000. It's all paper trading. There's no depositing of any money. It's just paper trading. And I have to say, in the spirit of this contest, people are trading futures. They've got their 10 contracts. It's actually very nice and humbling to hear that when you go into futures market, what it really stands for is that, for example, farmers are accessing these markets for critical hedging purposes. Maybe you can just remind our viewers about that, because I think it really puts a pretty cool, I should say, frame on futures trading, that like, this is the real deal. This is food. This is physical products. This is big time stuff. And just sort of remind them maybe about that. Even for me, I'd love to hear more.
So let's talk about that. When you look at indexes, which everybody looks at, they're financially settled, which means that if you buy an S&P 500 or an E-mini NASDAQ, it's settled financially. So wherever the market closes, you're going to get a statement saying this is where the market settlement is, and then they're going to mark your position to the price of that settlement, and you're going to get credited or debited accordingly if you hold it to expiration. Now, none of these futures traders out there right now trading indexes are holding E-mini S&P till settlement. They're not doing it, but there are a lot of people that do. It's very similar to way an option would settle, right? I'm sure a lot of people are familiar with an option. So a future, in some respects, is very similar to that. Like where it settles, the value is where you're going to get debited or credit, but it's financially settled through dollars, right? When you look at commodities like cattle, soybeans, wheat, They settle monthly, not quarterly, like the financially settled products, like the S&P and NASDAQ. And what happens is at the end of every month, that's why these commodities have monthly expirations. Some of you probably know if you've traded crude oil, natural gas, there's monthly expirations, and you have the front month, the spot, right? And then you have all the different months that follow it. When you look at equity indexes, they're only quarterly, right? And so there's a reason for that. It's because at the end of every month, there's going to be physical delivery for crude oil. There's physical delivery for gold. There's physical delivery for, cattle. There's physical delivery for all these things. Now you've got to be registered through the exchange to be able to actually provide physical delivery or take physical delivery. Most of the time, if you're somebody who's holding the crude oil or gold contract toward the end, they're probably going to call you and be like, hey man, you got to cover this, or they cover it for you. Your broker will take care of that. But that is how the business is done. And, imagine you're somebody who's got a ton of corn, right? And all of a sudden corn prices spike and you're like, whoa, you know what? I think this is going to be the high. I think there's going to be a massive amount of supply. You might short corn futures as a farmer to lock in price, and you might actually be physically delivering at the price that you shorted because you sold it there. You actually sold it. You didn't buy it there. So you're actually going to have to be one of the people who are delivering it, or you're hedging price action against your crop, because let's just say corn spikes 20, 30% because there's some news that comes out and you're like, I don't think that that's real. Futures are a place to hedge it. I mean, that's what they were built on. That's why it's the Chicago Mercantile Exchange, Chicago Board of Trade. This is where, actual trade takes place. And we're all fixated on equity indexes, interest rates, but all of that came way later.
That's so interesting. Actually, I was going to ask I'm going to ask this question first, just because of the way you ended that. I actually did not know that. So the equity contracts are sort of a newer product relative to the physical things like corn, wheat, oil, etc.
Oh yeah.
Fascinating.
The S&P 500, I believe the first year was, let's call it 83, 82, somewhere in there. I think was the first year that the S&P 500 became a futures contract. When you look at the stock indexes, and everything kind of followed suit there. I remember when they launched the NASDAQ. I remember when they launched the euro currency. And so those came much later. And obviously wheat, corn, and those products were around for, 100 years. I don't know exactly when those products actually began. You go back to like cotton is one of the first products, sugar, cocoa, those types of products that have just been around a long time. When you look at the Dow Jones Industrials and you look at like the crash of 1929 and all of those types of things, when you go back and you look at those as an index, we're not talking futures there. We're talking, actual stocks. So on the derivative side, the indexes came much later. Financial futures came much later. I should always plug a book about Leo Melamed. Is probably one of the most historic figure in futures. Go look up his books, and he talks about how he actually brought financial futures to the Chicago Mercantile Exchange. As I met Leo a bunch of times, great guy, still alive. I think he's probably late 90s.
Great history lesson there. And for all of these sort of market nerds, take notes of that author and book, and we'll put a link ideally in the description after this chat. And I'll just say as an example, I have the symbol search up on TradingView with CME, and I'm just scrolling through it just to see Swiss franc futures, live cattle futures, lean hog futures. There's just so many fascinating instruments in here when you search by CME. It's like there really is. I mean, non-fat dry milk futures, fascinating, right? It's so fascinating. And I love the context you put on that about how like there's real industry here that's needing to sort of research or chart or trade these instruments. How about the aspect in terms of, because I see some people in the chat asking about how on the leaderboard here for this contest, someone has got, they're up to $8 million in this 1 month trade. And I believe they're up like 3,000%. Now, I want to just transition the conversation to risk management. I know that's a specialty of yours too. Maybe speak to us a bit about how the futures market can open up certain risk principles or the way you can get access to contracts with specific amounts of capital, because I think it's important to sort of, talk about that feature as well.
I think one of the key features that futures has is cash efficiencies, right? I mean, when you look at the notional value of the S&P 500, it's a $50 contract times, let's call it 6,000. Not everyone's going to come up with 50 times $6,000 to be able to come in and trade that product. When we say $50 contract, it means that every point it moves, it doesn't move in $1, even though the price says $1 move, it's actually moves in $50, right? So if the S&P right now you've got is trading, 90 half and it goes to 91 half, half is 50 cents. If you don't know, that's just, I think if you're going to be in this business too, Steph, I might use some lingo, question that at any time. So
I like it.
half,
No, I like it already.
yeah,
You said 50 half. I can already tell you're talking like a true trader. 50
yeah,
half, or
50 half.
it's
So,
great.
so 90 half to 91 half is 1 point. That's $50, right? And you only need your broker's margins to be able to trade that. You don't need the full notional value. You don't need the total contract value of the S&P 500, right? And so to trade one E-mini S&P, let's call it overnight margins, is somewhere in the vicinity of just below $20,000. Same with probably Nasdaq's probably right around there as well. I don't know what they currently are. They're changing because of the way how much the price moves. And for the micros, it's going to be 1/10 of that. And then you have intraday margins where they're going to be, a fraction of that, right? And so depending on what you're, who you're using, obviously at NinjaTrader, you could trade, one mini, and you probably only need to have somewhere in the vicinity of $500 per contract, and one micro is probably going to be anywhere, probably right around 100. So maybe it's 1,000. Actually, I think it's probably right around $1,000, or give or take, for one E-mini S&P. It's going to be a little bit different for the Russell and the Nasdaq because they're all a little bit different in what their margins are. And then a micro will be 1/10 of that. So maybe you need $100 to trade one micro E-mini S&P. Now it gives you the ability to take advantage of price moves that you don't need the notional value of, right? So you don't need, hundreds of thousands of dollars to be able to participate in the futures markets. That's the cash efficiency aspect of it. You can come in there and you can make 10 points in the S&P on one contract. Let's just say it costs you $1,000 to get in. Your risk obviously can't be more than 1,000 because you're going to get shut out. But let's just say that you had $1,000 of risk in your account. You bought one E-mini S&P and it won 10 points. You're going to make $50 a point times 10. And so that's a very large return on a very small amount of money.
Which is a really nice feature. And I will say to your comment too about using these types of words or trader lingo, I've also noticed that about futures too, that some of the newer traders or investors out there who are getting involved are struggling to sort of wrap their head around the math of it all. I don't know. Are there any tips that you have just to sort of, of course, go do your research. There's plenty of resources online. There's videos, there's articles, but maybe there's some tips you've learned along the way just to sort of, I don't know how I would say this, just to just quick mental reminders that some traders could keep in mind as they go through. And look at this, but I'm watching the E-mini futures. The action's pretty exciting right now. But any tips for aspiring futures traders in that regard?
Well, when it comes to risk management, I mean, what's interesting about today's world is you have evaluation services, right? And a lot of those people are using the NinjaTrader platform to go in and they're looking, they call them props. They're really not, they're evaluation services. I'm a little bit more old school. A prop group is not what these are, but they are evaluation services that fund traders. So I think that from that perspective, that's a interesting way to get into the industry and learn about futures. NinjaTrader also, offers simulation. I think going in and becoming a sim trader to start is the right way to do it. I think to get a feel of these products, I know we could talk financially, you and I, about how I would manage risk and look at that, but I think that when you get into the space, people are coming in from these avenues. I highly recommend, if you come to NinjaTrader, you're on a sim first and you do some education. That's things that we're focusing on, have people understand futures. I mean, you go back to look at where that S&P chart was, Steph, we just broke 10, 15 points, or
look at that move just in the last 30 minutes. Yeah.
And so you look at it and go, even if you're trading one contract in the S&P right now, you're up or down $500 to $1,000 if you're wrong side of that move. So, and that's just in the last few minutes that we have been here.
Last 15 minutes.
Yeah. So if you look at it and it's even really a 40-point break, which would be two grand, from the recent highs. And so it goes back to getting a feel of it, I think is important. We're putting out a lot of new great products through our trader engagement at NinjaTrader to help people understand how futures work, because I think before you touch them live, you should understand how the products work. And I go back to that list that you had, how many different products there are. I think everybody gets so hyper-focused on equities. I think a lot of people should be looking at the bond market, looking at 10-year treasuries, looking at, potentially trading the euro. They might find something that resonates with them more. They're all different tick values, they're all different margins, they're all changing, but do your homework. Now, when it gets to financial amount of risk, because futures are naturally leveraged, you're going to be risking more on a single trade a percentage of your account than you would be in your stock account. That's natural. It's, a lot of people will put in $5,000 and they'll start trading 1 to 3 lot E-mini S&Ps. And I'm not saying that I would be against that by any stretch, but I would always say that you have to have some experience before you get to that point. But I think a rule of thumb, a real easy tip is, if you put in $5,000 or $10,000, know that you're already naturally leveraged in the future space, and look at it from a real return perspective, right? I think so many people get hyper focused on turn 10,000 into 10 million. I see these stories all the time. That's so unrealistic. If that's your goal, well then, best of luck. It's just, and even those stories of those people doing it. I started with a small amount and had, I made a lot of money in my career, right? And so it doesn't mean that I turned a small amount into a large amount. I incrementally had to get there and figure it out. And each incremental amount that I got in more account value has brought its own challenges. And at the end of the day, I kind of always lean on, if I lose 10% in a day, because you don't need to keep a ton of money in your futures account, because again, it's naturally leveraged. That's a horrible day. 5 to 10% to me in a futures account is not like losing 10% in your brokerage account that you're, using cash, to trade Tesla. It's just a little bit different. And so you could have a little bit wider percentage risks because it's a naturally leveraged product and you're not putting in all of your capital. And so that's why it's always unique from that perspective and for people to be aware of it. But, most people come in underfunded, but at the end of the day, and I don't think that's the worst thing to try the markets out, but also keep it, to a reasonable number of single digit to maybe a 10% risk on a daily or a weekly. I don't think is so bad. And I know some people might push back on that, but I think if you're trading futures, that's part of what this is. They're risky.
I was going to say that 10% limit, and correct me if I'm wrong, but like an equity trader would say maybe like 2%, right? And I think you're right because cash. So that 10% even has my antennas go up. Could you just elaborate on that a little bit more?
Well, think about it. If you go in and you buy, let's just go back. Let's look at let's just say a stock is, $500, or let's just use Tesla. It's at 300, whatever it is right now. It's everybody is kind of watching Tesla. I own some Tesla, right? And so at Tesla stock, if I buy this in my long-term holding account, I'm only using, first of all, let's just say that I have $100,000 in an account. I might buy 5 or 10% of my account in a single stock, NVIDIA or Tesla, something like that. And I might allocate, however many shares I want to that. Now that risk of my overall total account might be 1 to 2% because I'm managing a portfolio. But if I bought Tesla at 10% of my total market, total account value, and I get down 1 to 2%, well, I only use 10% of my cash, right? In futures, what's happening is people are putting in $5,000 or $10,000 or $25,000, and you're immediately in a notional value above the account value, right? So therefore, your percentages are going to be a lot higher of your risk. You think about it. A $10,000 account, you lose $500. There you go. If you're trading futures and you're trading micros or E-minis, that product is moving so quickly with the leverage that you're going to be up or down $500 on just trading 1 or 2 contracts easily. So most people are already in that category of maximizing the amount of leverage and margin right out of the gates. That's the difference. You're not managing a portfolio per se for a lot of these short-term day traders. So that's what makes it different.
So I have to say that's a really nice segue into I think this leaderboard. And by the way, I've been watching this leaderboard really closely as the S&P 500 futures started to tumble. I thought I'd see some profit here disappear, maybe if people, if the volatility was messing with some of their returns. But essentially, but no one's moved. My guess is this guy in
They're
first.
just holding tight.
I think they're holding tight. And then Ben Bernanke too, which I find that is hilarious. We got Ben Bernanke 1 and 2nd. I think you're right. He hit 3,378% and said, like, catch me if you can. There's 24 hours left.
I would be doing the same thing.
Exactly. That's what I'm guessing. And the top 3 have not budged. So I think they're probably all in cash right now and letting everyone else trade among, in this volatility. But of course, the margin requirements in the contest will have an impact on this. But would you say essentially that type of leverage is in this simulated environment is allowing these traders to capture such like massive moves within 30 days?
Well, you go back to it. Well, how much did they start with, Steph? Let's talk about that.
Yeah, let's actually see. Let's get all the contest.
So his realized profit is $8 million, right? If I'm reading that correctly. If you look at what they're starting with. Yeah, so again, I go back to it. If you look at a retail futures trader, non-professional, newer person coming into the futures markets. Now people are putting in, let's say, 5,000 to 100,000.
Here you go. Anthony, sorry to interrupt, but 250,000 virtual US dollars.
Okay, and so most people are not coming into the future space putting in $250,000 again. So the risk, again, this person probably was taking 10, 20, 30, 40, 50% of risk on a trade because they're using so much margin. And they're using because the product's naturally levered, it's not like that same thinking. I think it's the hardest transition for people to go from, I manage a portfolio, I've got 100,000 or $1 million in my account. Why would I come in and lose 5 or 10% on a trade or a day or a week in the futures markets? Well, that's the cash efficiency side. You're not going to put your full $1 million in the futures account. Most people are not going to do that, right? Most people are going to come in, they're going to allocate a portion of that portfolio. Let's say $1 million person puts in $25,000 into a futures account. Well, if they lose $25,000, they're still only losing, 2.5% of their million, right? So they're risking a much greater amount on that account because a futures naturally leveraged product. I mean, that is the separation. So it's not like I'm saying, go in there and lose 5 to 10% on a trade. And that's not normal outside of futures. But in futures, that's what you're going to see most of the time. On a personal level, I keep myself right around 5%. If I'm down 5%, 3 to 5% in a day, well, I'm done. You know what I mean? But there's days where I'll make 10, 15% of my account. Right. And so again, this is different because it's naturally leveraged. You catch one big move in the S&P or NASDAQ, you can make a great percentage.
And on that note, because I think the volatility the last 1, 2, 3, today's the 4th, I'm on a daily chart. Yep. 4th day. If let's say you're in the contest and it's all paper trading, the key here too is risk management education. But I just want to talk about sort of how do you play volatility or a down move like this? Of course you could, short the E-minis, but what other instruments come to mind because I want to talk about just the different ways you can play or find safety in down moves like this.
Well, first of all, again, you go back to what were futures originally created for, and they're created as a hedge, right? And so if you own a boatload of stock, right, and you immediately need to sell to hedge against your portfolio, or you immediately need to hedge against your portfolio, you may not go and sell millions of shares of Microsoft or whatever it is that you own. If you're managing a big portfolio, what's the best thing to do is to keep money in a futures account. And if the markets go down, a big player in this space just sells a bunch of futures to hedge against their long portfolio, because it's the easiest way to be short in the market. And it's the most cash efficient way. So think about it from this perspective, right? So when you look at the futures, the reason why we go down so much quicker, most people are long stocks. Right? I mean, not most people are in short stocks. So most people are long stocks. And all of a sudden, a bunch of brokers coming in and they're like, listen, we need to hedge against our S&P holdings, our top companies, or they're getting clipped, or NVIDIA's getting clipped. Now, if you own a bunch of NVIDIA for a bunch of clients, are you just going to come in and just start selling some of your NVIDIA because it's going down, because it's part of your long-term portfolio? Maybe you don't want to sell it. You sell futures. Wow. Because that's now immediately you are short the market against, and because you're getting so much leverage against your large amount of cash holdings. That's why the markets move the way that they do to the downside, and that's why it's elevator up and then, straight down.
Escalator down. Yep.
Escalator down, right? And so when you look at it from that perspective, it makes sense, because those people, the biggest traders, especially when you get all the day traders that want to be short too, are going to come in and just start hitting bids, because nobody wants to be the last one to hedge against a down move, because you don't know where it ends. When risk is coming out of the market, everybody's chasing it. And that's why when you go down, that's why we go down the way that we do. And we don't go up the same way we do, because nobody wants to be the guy that buys the highest prices, but then it kind of grinds up and it kind of does this move when flows are coming in. But when they're coming out, everyone's going, just cover it. Get me out, right? And I used to see that firsthand in the pit, and I used to see how that used to look. And so if you're a trader, or you're someone new to futures and you have a bunch of stock holdings, or you're looking at how you would come in and look at the futures markets and I don't know what the exact question was, but like trying to short these markets, or you could, that's the other thing, is you could short them as easily as you are long. The margin's the same. It's no different. You could sell a future the same cost as you buy a future. So to me, that's why it becomes so much more strategy on futures. It's much more strategy driven. It's much more day trader driven, because those traders are trading both sides, and they're just using the margin, the leverage to trade both sides of the market.
So I have to say, I love this part of the conversation, and I know a lot of people who watch the show have a sort of fascination with institutional money or hedge funds, right? It's got the glitz. It's always making headlines. I actually never put that together. Can you just walk us through that again? So essentially, you could imagine someone has a large position in multiple stocks, but they're not just going to go liquidate the stocks on a down move. They can hedge easily with futures products, or maybe they're short the stocks and they want to hedge by going long. That is so interesting. I never put that together, that some of the large institutions are potentially using products like this in such examples. I don't know, any more color to shed on that? I think it's a really cool insight. All the new traders out there, or people fascinated by hedge funds, might find that interesting.
Think about it from this way. That's why the beginning of the month and the end of the month and the beginning of the quarters, the end of the quarters are very busy in futures markets. Just go and look at the volume and watch at the end of the month, watch the beginning of the month, at the beginning of the day, the end of the day, and why there's so much more liquidity coming in. It's because of those reasons. So think about it again, where we started, right? It's the initial place to hedge. So if I owned, I use the corn example, right? A bunch of corn and corn spikes. I want to sell corn at that price in case price comes back down. I've shorted there. I've either hedged my portfolio, or I can just sell corn at that price. So there's that thinking, right? Now imagine I own a bunch of stocks, which tons of family offices, hedge funds, everybody, the whole world is, a lot of people are owning stocks, right? And so when the market starts to go down, or if all of a sudden they think the market's going to go down, what's the most cash efficient way to hedge against a large portfolio? Sell the S&P futures, period. I mean, that is it. I mean, if you're Goldman Sachs, if you're Merrill Lynch, that's why I used to stand there and look at those banks in there, and all of a sudden they come in selling a lot at the beginning of the month or end of the month, because all of a sudden they have to, they have this offset. What's the easiest way to get access to the S&P 500 is you can buy futures, and it costs you minimal money in an account, because again, the notional value is so much higher than the amount that you have. So again, you buy one S&P, one E-mini S&P, your margin, like I said, is just under 20,000 for overnight. So a big bank is using that number, versus them having to go buy, that notional amount, and to get that value that they're getting in the future. So they buy 100 or 200. That's why the big volume comes in, and they have immediate access to the S&P 500. So they might make 1 to 2% on that account, or 3% or more, 5%, like we've been talking about, on just that part of their portfolio in minutes. Or they hedge against that part of their portfolio, and it saves them 1 or 2 basis, 100 or 200 basis points on their portfolio, because they shorted futures and then covered, and they took that gain, or they kept them till expiration, or whatever it is they did. That's why it comes in and out so quickly in those moments, because these guys are looking at it going, man, when you think of futures markets, you have to think a lot of times people are going there because they have to do something. It's why we move the way we move. Not every scenario is like that, but a lot of them are. Meaning at the end of the month, the market's gone straight up. We're grinding up. All of a sudden, everyone goes, well, they're marking the books up into the end of the month. They're buying the market. Well, they go to the futures markets, because if they haven't been able to get filled on their long S&P, all of a sudden they come in and they start buying S&Ps in the futures. And for a small cash amount, they get access to a large notional amount that drives the market higher, and they make a great percentage on a small amount of money quickly. So does that make sense? That's why futures move the way that they do.
That makes a lot of sense, and that is also why we do this show, because of insights like that. That is awesome, and I had not put that together. You know, I'm still technically new to futures. This Leap contest has got me started, and that right there just is like, oh my gosh, it just clicked for me. I just can see it now. And I was thinking too, while you're walking us through that example with equities again, correct me if I'm wrong. So this can also apply to, like, you know, let's just say Bitcoin. I've thought of Bitcoin futures. If you're someone who maybe owns like a basket of different cryptocurrencies, this
Bingo.
Bitcoin futures contract is a great way to hedge, right? It's the same concept.
Bitcoin, gold. I mean, you look at Bitcoin futures. I mean, to me, Bitcoin futures is probably the best example of this, because most people that own Bitcoin, I wouldn't say most people, I think that's probably changed a little bit, but a lot of people for a long time, weren't they hodlers stuff? They just bought their
Oh
Bitcoin.
yeah,
They didn't
they
cover
never
it,
touched
right?
it. Yeah.
So let's look at it from this perspective. Bitcoin gets to 110,000. You say to yourself, you know what, man? I don't know, man. I don't know that this thing is going to push much higher, right? And all of a sudden, you're saying to yourself, but do I go in? It didn't quite get there, right? But it gets
You
near
know,
there, and
it
you're like,
just
I
tagged
want to
it.
sell it.
Oh, that's so interesting.
It got
Actually,
right near it, right? So it
it
gets
looks
up
like,
there.
yeah, like $5 below it, which is
Yeah.
pretty amazing.
So, and you say to yourself, I think that's a good high, but I don't want to sell my Bitcoin because I don't know how far it's going to go down, and I don't want to sell it and buy it again. I just want to hold it. Well, I could use Bitcoin futures or micro Bitcoin, and I could sell a future against my Bitcoin holdings. So now
Amazing.
technically, I'm not really short Bitcoin, even though I shorted the futures, because I'm long, let's call it 5 Bitcoin, and you sell one, Bitcoin futures. I think it is 5. I usually trade the micros, which is 1/10 of one Bitcoin. But nonetheless, let's just say that that's what it is. And the market comes down and you buy that back. You weren't technically short. All you were was hedged against your position. So you look at micro Bitcoin, which I think is great. I think it's a really great product for retail traders. I dip my toe in there every now and then. It's the MBT.
There it is.
That's
Micro
1/10
Bitcoin.
of one Bitcoin. So now, I mean, the reality is what I like about the micro Bitcoin is really you can trade 1 is 1/10 of one Bitcoin. You could trade 10 as one Bitcoin, or you could trade 50, which is 5 Bitcoin. You can get as big as you want. That's why I like the micros more, because I can adjust my position sizing better than the BTC. But nonetheless, if I own 0.3 Bitcoin and I want to sell I could sell 3 micros to be completely hedged on that Bitcoin position by using the micros. So technically I'm flat, I'm short futures, and I'm long Bitcoin cash, right? Or cash or whatever. And it's not Bitcoin cash, because I know there's Bitcoin cash, but you're long Bitcoin. And the market comes down 20,000 points. You made money on the short, you lost money on the long, you're net zero. But now where you want to buy back in the Bitcoin, you buy back in the futures, and you never sold your Bitcoin core position. That is what futures are created for. Now think about this again. This ties into, think about the stock portfolio people. Same type of thinking. I own a bunch of stocks. I don't want to cover them, but S&P might go down 10% from here. I'm just saying. Let's just say that might happen. I sell S&P futures. I'm not going to sell all my stocks, because if the S&P goes down 10%, I know for sure my stocks are most likely going down 10%. So now I offset that with my futures position. I buy my futures back, and I still own my cash holdings. This is a lot of how the futures markets work. And that's why they're such a great tool for really all sorts of people, all levels. You could be a retail trader, like I said, who comes in and goes through eval, sim, and then gets to us with Ninja at live, which is, obviously great. And that, or you're just a small retail trader with a few $1,000s or $10,000, or you're a trader who's got millions in your stock account and you're using, someone like Ninja to hedge against that account. You're using futures to hedge against it. It's really, that's the beauty of futures. And I'm glad that the world is seeing it more and more of that these days.
I also really like that, just in the Bitcoin example or any of these other asset classes too, in the aspect you don't have to. So if you love your entry position, and then in the case of Bitcoin, like if you got in at like $100, you're just like, I never want to take that position off.
Exactly.
That's pretty neat that you can hold on to that amazing entry for as long as you wish and hedge without, without sort of feeling pressured ever to sort of take those gains immediately off the table. That to me is really alluring, especially if you have a great entry on something.
It's
And in
called
terms of
trading around, it's called trading around a core position, right? And I think that's the beauty of it, right? I mean, that's the premise of where it started in this industry. And obviously it's gotten way more into day trading, which is great as well. Like I said, it serves both purposes.
trading around a core position. Tell us. So from what I gather, we just effectively spoke about trading around a core position. I just want to ask any other key insights there, because I think that a lot of people might find that rather fascinating for some of their favorite long-term holdings.
Yeah, no, I mean, it's just, I think we covered it well enough, but I think just understanding the dynamics of a market, right? And thinking outside of just everyone's so focused on short-term strategies, trading futures, and they're looking for these maximum gains. I think to understand, you go back to when I started as a runner, how did it help me? It helped me understand how the business works. It helped slow me down as a trader and understand what futures really are, how they're used, who's using them, and then you see why they move a little bit. You understand the backdrop. You understand, why you see these moments where you see big moves in futures. In commodities, you see them in indexes, and it happens because the world is using futures as a place to hedge risk, period. And so when the world is chasing risk, right, when they're trying to hedge, right, and they're trying to do their best to manage and to trade around their core position, what they really believe in for the long term, futures are the best place to offset that in times of turbulence. It's why we were so busy during COVID, man. It's why, we're always going to be busy during times where, you have administrations like we have right now. There's all sorts of things changing on a dime. Where do you go? You don't go to stocks immediately if you want to hedge, right? You're going to go to futures. You go to the indexes.
So on that note, and before we wrap up, because I know we've hit that 45-minute marker, I just want to just a few more quick topics to cover, and even a question or two from the chat. This is one I've often wondered about futures. Let's say, for example, it's Sunday night and you are, I don't know, it could be any asset class, and you just want to check on how your, how that asset class is trading within the index. What exactly are you like? How do you read into that? The Sunday night futures, the overnight futures. I've always wondered, like, what's sort of the insight that someone like me, who's still new to futures, should take away from looking at those markets when, like, let's say traditional equity markets are closed 9:30 to 4, but then futures trade after, they trade on Sunday night. Any insights there for us on how we should be tracking those or looking into them?
So the one thing about the equity indexes is that there's really three opens, right? You have the US, the London, and the Asia open. And you really have the world looking to hedge risk through our markets. And so I think that's the scope I would look at it as, right? And if you're a US trader, I would still focus more on the US open in terms of your time frame for trading. But you have the London session and you have the Asia session. What that brings to light is, how is the world using our markets to hedge? And that's the thought process. Okay, that's the thought process. Because it's not that I think so many people think in terms of what are they doing to position themselves in the overseas markets versus hedge, because there's a difference, right? When a market's going up, pretty much everything's kind of easy. We all know technicians are always geniuses in bull markets, and everybody's always kind of chasing these rallies in the indexes. But when you get, like, you go back to like last August when you had that spike in the yen versus the dollar, and you have these things that happen overnight that before US markets hit, that's a time where futures markets are being used to hedge, because that's when we get the biggest moves. It goes back to why we go down quicker in equity indexes, but we also go up quicker a lot of times in bond markets, because that's also a hedge. Because if you're going to buy bonds, you think rates are going lower, and typically that's a hedge against, a world scare of some sort. People want to own US treasuries or bonds. So look at it from a hedge perspective. If something's happening in those overnight sessions, that's a fierce move. It could be up or down in any market that you're trading, and there's kind of a news tied to it. That's to be how I look at it leading into my session, right? That London was a snooze fest. What was Asia doing? Really not much. Get into US and see, because that's when you get the real tells. That's when the real trends are either made or broken down, when moments come to where the world has to hedge risk.
I like the aspect of framing it in terms of London, Asia, US. Haven't thought of it actually like that. So very insightful. And then the next question that I wanted to ask, because you brought up bonds, and then I'll just go to a question or two that I can see in the comments, is so I've historically tracked, TLT or other instruments like that for bonds. And before we went live, you had actually mentioned to me that you were pretty interested in some of these bond futures. You were saying you just seemed excited about it. But any instruments worth looking into in futures markets for tells or insights in the bond market?
Absolutely. See if you could pull up the micro treasuries. I think it's a good retail market. So it should be the 10. It'll probably start off with the 10
This
YY. So see,
this micro ultra tenure
no, not that one. Just type in
MYY.
10,
Yep.
10. There it is. See
Micro
it right
10-year
there? The
yield
10Y.
futures.
Yeah, click
10Y.
that.
All right.
Yeah, I want you to look at that and do the 10Y1. Yeah, there you go. Okay. So this is cool because I think, number one, it's $1 a tick. And what's cool about this is that you could actually trade the interest rate for the 10-year yield. Everybody watches the 10-year yield because it impacts us. Really, it's probably the global interest rate that everyone looks at. What's happening in the U.S. 10-year yield, and so if yields are going up or down, that has impacts on pretty much everything that we touch, right? Everybody knows that we're always kind of in an interest rate environment with the Federal Reserve. It's just kind of never gonna kind of go away. What's cool about this product that CME created, and I think it's probably one of my favorite products that they created for retail traders. And this could be for more than retail traders as well, but it's $1 a tick, and every time you can trade it. If you think that the rates are going to go to 4% or 4.5% from here, right now they're trading 4.265. It's $1 per tick, and you can actually express your view and by trading it as if it's an interest rate, but it's actually a future. And that's really cool to me because if you look at the bonds, the 10-year, 2-year, 5-year, they don't move that way. They move opposite. So if a bond goes up, rates are going down. I think it could be confusing for people. But this, you could actually trade the rate. If you think the rates are going to 4.5%, it won't get below 4.25, you can buy them. And it goes to 4.5, you can sell them. So you can make money on trading the actual rate itself. And so it's a viewpoint into a market that I don't think most people even know exists or can trade. And we have this available at Ninja, of course, but it's really it's a great product for retail traders that want to trade interest rates, and it's reasonably priced, I think, as well. So again, it goes back to how much money do you need to be able to trade this product? The margins are really low on this. It's $1 a tick. It doesn't move a ton, but you get to dip your toe into trading an interest rate product that I think many will find is technically pretty good. I know some people will beg to differ to say that interest rates themselves can be technically traded, but I've noticed that there's some good strategies for that. So this is a product I think every retail trader should take a look at.
This is really cool. So what I'm seeing is the 10. So I'm literally trading the 10-year interest rate. So
Correct.
4.267 is the interest rate right now, and you can
Correct.
trade it with that view. I will say
Yeah.
that makes it so much easier to read.
So much
Just as
easier.
incredible. Wow,
Because
I had
Steph,
no
you and I
idea
both
this
know
existed.
all the years that you and I've known each other for a lot of years. You go back, let's go back 5+ years, and you've been in this business a long time. We used to have to go and look up and see what the rate was. We couldn't really trade it, or we can go and trade like the ZN, which
ZN,
is
yes, that's what I was gonna do at
So
first,
if you go
right.
to the ZN, okay,
Right, I've
now
never understood how to read this, I have to be
so there you
frank.
go. But
Like
this goes back
110,
to
5.
yeah. So this equates to 4.265. Now, for retail traders, it's not an easy thing to understand that. And I wouldn't understand it. I've been doing this a long time. I mean, obviously there's a mathematical equation that's built into how it works. But when you look at this, it's when they go up, the rates are going down. So that's confusing, right? And so now they've created a product, and it's also a much bigger tick value. It's 1563 is the tick value. And so, ZB is 31.25. And so when you look at that, it's a much more expensive product to trade too. So and they move, believe me. But that's why I like this micro 10-year yield for traders to trade. Great product.
Myself as well. In fact, I'm going to add this to my watch list, quite frankly, because I just don't want to forget about this.
And even if you're not trading it, right, stuff, you know what
Oh,
the
this
yield is. It's
this is
live.
incredible. This is incredible. That's why I'm adding it to my watch list. I want to know what the yield is, and actually seeing this chart so clearly to me is that, oh, so markets are going down. Look at the yield going down. Like, what an interesting change in sort of people's perception of risk at the moment, all happening. Very
Bingo.
crisp to see here. Really nice stuff. I have a friend who messaged me on X watching the show that I thought was pretty good. It might apply to everyone out there if you're ever going to buy a home. Can you chart your trade to 30-year as well in a similar way?
Yeah, you can. It's available on there. And yeah, there it is. It doesn't trade as much. I was going to say it doesn't trade as much because when you get out into the long end of the curve, you don't see a lot of movement on the actual rate
Oh yeah.
here in the futures markets. The ZB is going to be where more of the action is. Yeah, I think that smooths it out. That's actually a good way of doing that stuff, the way you did that with that chart.
The line.
The
Yeah.
ZB is there, but again, it's tradable. You got the 2YY, 5YY, 10Y, and 30Y. So 2, 5, 10, 30 is what you can
That's
trade
so
on.
interesting. Do you know anyone who charts these types of symbols and is like, now I'm buying a house? Or is that
No, I mean, I know, but I mean, I guarantee there's people out there doing it, man. It's great.
yeah.
You know, what's funny about the markets is that I don't care who you guys follow out there to get your insight. And there's so many different ways to make money or find your way in markets. I think that's what makes it so great. I mean, all my mentors they traded a certain way. I took something from each one of them. Some of it's mental, some of it's what I do in my personal life, some of it's technical, some of it's macro, and you find your own way. I think that's the beauty of markets, and you do what resonates with you, and because that's what you're going to stick to in the end. Nobody has the exact methodology that's going to work forever. It just doesn't exist. I wish it did, but the point is to go out and try things. I go back to like where I said, use the sim on NinjaTrader. Go on there, test strategies, do things of that nature. Get yourself prepared for live markets. Maybe evals for you. Again, I think there's just different ways to access our markets these days that aren't that didn't exist in the past, and I think it's really great.
And we have 5 minutes left, and there's one more question I forgot to get to, which is, do you know anyone who's ever actually taken physical delivery of, say, one of these like asset classes? Like they had gold futures, they made a great trade, and they actually waited for the gold bars to arrive.
I don't know anyone that's ever taken it for gold. I mean, I've met several people that are in the energy space, and that's probably the only example I know of. And those are just people that are professionally in it from an independent basis. No, I don't. I don't know anyone who's personally done it. I've heard some stories, but nobody I've known on a personal level. And again, I don't. There are restrictions to this because I've never been someone who's looked to take delivery or someone who's going to be delivering, any one of these commodities. I've never looked too deeply into it, but I'm pretty sure that you have to have. I'm not pretty sure. I'm sure you have to have a contract set up with the exchange, and you have to be an authorized dealer. That like the exchange has a set amount of gold that's it's warehouse somewhere, and oil. Like these things are already in inventory based upon certain projections. I don't know what they are. That'd be a great conversation to have with somebody from CME about this. But it's for the delivery method. It's it's a very formal way that they do it. Somebody doesn't just trip over the plug on their computer and get delivery of crude oil. Doesn't happen.
I've always just had that visual of like someone's trading futures. They make a great trade, forget to close it. They get a knock on the door. They look outside, and there's like 10,000 barrels of crude oil outside coming right to their
Oh
front
man,
yard.
mom.
Yeah, exactly. Exactly. Well, on that note, those are all the questions. Unless there's one more here about someone wants to. I think we hit all the questions so far. Unless I always like to end the show with some sort of final insights or sort of educational topics that you really want to send home to everyone watching, or even if you just have a sort of takeaway from. It was so interesting because while we were doing this chat, like, wow, we started about an hour ago, so like we actually saw some nice down action here too across E-minis. So I don't know, any topic you want to end with, insight, could be current event or just educational. I'm all ears, and then we'll hit that hour marker and wrap up.
I think something to look at going into the next couple of weeks is rollover. We didn't really get into that, and that's expiration for indexes. And I think it's such always an important time for markets. And I talked about this in a spaces I did the other night. My view on rollover a lot of times is that if a market is in a primary trend and you have any sort of mean reversion or reversion or reversal of trend, a lot of times it runs into um, rollover. And rollover is a change of contract. We're going to go from March of 2025 to June of 2025 and S&P, Dow, NASDAQ, and Russell. Excuse me. So I could see this move having some legs heading into that time period, and watch how markets trade around rollover. It's unique because this is also what makes futures unique, is that you have these surges of volume, you have these let's call them these random type moves, because again, futures are a place where people go when they have to do something. They go in because they're being in a rush to hedge or in a rush to get access to. So it happens a lot. And when you get towards an expiration, because we talked about physical, right? But in this instance, it's towards the end of the month. It's getting towards the end of the quarter, right? A lot of people look at options expirations, but they don't talk as much about future expirations on the indexes. It gets really dicey during those times. And a lot of times I've seen a low or a high made, leading into those times. Then we change contract, and it's almost like, oh, we're in a new contract. We've got a little bit more time now, and the market takes a breather. So that's something to take a look at, and just educate. Last thing is educate yourself on this business. I just talked about rollover. It's unique. It's different than what you're used to from a cash product. Take your time in this industry. I say this every year during the holidays to everybody on X and everybody, and I have a free Discord, and I talk about trading all the time with everybody. Give yourself the gift of time. This business, people are so hyper rushed in this business. They only see dollar signs. They come in, a lot of it with the wrong intentions, turning into percentages like you see here today. They're very unrealistic when you get into real dollars. And it really does come down to managing risk and managing your time, staying in the business long enough to have an opportunity to do what some of those people did, even though it was in a sim challenge when we get back to the leap. Those gains are not impossible, but those gains happen when somebody has gone in the market long enough and they've positioned themselves to take an opportunity when it arises. It doesn't happen with real money early on. It just doesn't, and if it does, God bless, take the money and maybe, go sail away. But the reality is it takes time. This business is all about time and experience, because that's where you become the best executor of your strategy. It's not the strategy that's going to make the trader money. It's going to be the best executor of that strategy that takes you to the level that you wish to be at.
Fantastic way to end the show. And Anthony, I have to say, for me, this show was probably one of the more insightful shows I've had in terms of like looking at it from a real pro perspective around hedging and how the funds use futures. And that little chat we just had too about using futures markets to hedge some of your positions without having to sell them. That was, chef's kiss type of thing. That was fantastic. I think a lot of people are going to find some great insights from that. And as the leap comes to an end, I don't know who's going to win yet. This is the final leaderboard. Let's see if Ben Bernanke 1 can, make a move here. He's
Make a
got
1.1 into the close. He better be
yeah,
short.
Yeah, he's only got about 1 day left, and let's see what Ben Bernanke 1 can do. He's got the money printer, so I mean that guy should be able to pull anything off at this point. But Anthony, thank you so much for joining the show, and for everyone who's been following along the leap and joined the leap, thanks so much for being a part of it. We hope it was educational. We hope you learned something new. We'll have more contests in the future, and also, of course, too, I think it's really cool to have Anthony on the show as well, because NinjaTrader is currently in beta as a broker integration. Super exciting. We should discuss that again in the future as well. And thank you so much to everyone who joined. And we will be back next month with another live show here on TradingView. Thank you, Anthony.
Thank you.